John Dunleavy back with another video. And today we're going to do a deep dive into the S&P 500 and talk about the components. And really there are 11 different sectors within the S&P 500 index. I'm sure everyone's been focused on technology, you know, the AI boom. That's been the last, say, 3 years. The market's been dominated by technology and the explosive returns we've seen as that sector of the market is ramped up. Clearly, technology is considered a growth part of the index. It really is the largest individual sector at 32.9%. But really what I want to talk about also is not only the individual 11 sectors, but also the way they perform and what they are. So, for instance, the technology sector, as I mentioned, 32.9% of the index, but has a minimal dividend yield. And usually if you have a low dividend yield, that reflects a growth company. And usually you're also going to have a high PE, and PE stands for price to earnings ratio. Currently it was 39.1 PE, so that's a very high. And then there's another part of the market they call the beta. If your particular portfolio moves in conjunction with the S&P 500, that would have a 1 beta. So it's equally moving or volatile as the overall market. But the technology sector has a beta of 1.2, so it's 20% more volatile than the overall index. You also have some of the other sectors of the market. We've got financials, of course, which are by definition interest rate sensitive. They do better when the Fed's cutting short-term rates. That usually improves what they call their NIM, or interest margin ratio. So a steeper yield curve is generally good for financials. The biggest part of financials, of course, is U.S. banks. You've got other sectors of the market, including communications, healthcare, industrials, consumer defensive, energy, utilities, real estate, and materials. But the reverse of the growth stocks, you have the value stocks. And the value stocks, unlike the technology or the growth stocks, they pay higher dividends. And the reason for that is that they're not growing as fast. They're more mature companies. These could include food companies, consumer products companies. They're a lot more stable in the sense that if the economy starts to slow or people continue to buy these things, they need gasoline, they need food, they need the basic essentials. So they're always going to buy these products. Therefore, they're not growing as fast. They're not the sexy companies of the market. Consequently, they'll trade at lower price to earnings ratios because they're not what they call four baggers, where you're going to hit a home run like you might in the tech sector. Because of that, they're going to have low sector betas. So, for instance, the defensives may have a 0.5 or 0.55 sector, meaning they're about half as volatile as the overall market. So these are kind of the things that you have to understand about the different components. If you own them all, they tend to balance themselves off. You get the more aggressive and the more defensive parts of the market. And they're going to move very different ways. As the markets gets hot, defensive sectors are kind of not in vogue, so to speak. Some of the names, the largest names in each of these sectors, of course, technology. You've got NVIDIA, you've got Microsoft and Apple being the biggest. Communications sector has Meta and Alphabet and Netflix. Some of the defensive parts of the market, you've got Costco, Walmart, Procter & Gamble, names like that. The energy components, would be like ExxonMobil, Chevron, ConocoPhillips. Utilities, these are your electric companies. So these are the big names that are in each of these sectors. And then if you kind of want to break them out into cyclicals, meaning, they do better when the market's booming. That would be discretionary, consumer discretionaries, technologies, materials, financials, industrials. And then non-cyclicals, of course, consumer staples. Healthcare is another one that people need regardless of how the economy does. So with that, just wanted to give a brief 5-minute talk on the S&P 500 index. This is John Dunleavy. I hope to see you in the next video.